The story of Ray Dalio, the man who built Bridgewater Associates, one of the largest and most influential investment management firms and hedge funds in the world. Ray Dalio was born on August 8, 1949, in Jackson Heights, Queens, New York City. The world he entered was still recovering from World War II. America was transitioning from wartime to peacetime economy. The Cold War was beginning to shape global politics. The stock market was in the early stages of a long bull run. Television was becoming widespread, transforming how Americans consumed information. Suburbs were expanding as families left cities. The middle class was growing stronger than ever before. Jackson Heights in 1949 was a working-class neighborhood in Queens. It was home to immigrants and first-generation Americans trying to build better lives. The community was diverse, with Italian, Irish, Jewish, and other families living side by side. Small businesses lined the streets. People knew their neighbors. The American dream felt achievable through hard work and determination. This was the environment that would shape young Ray's early worldview. Ray's father was Marino Dalio, a jazz musician who played clarinet and saxophone. Marino came from an Italian immigrant family that valued music and creativity. He performed in clubs and bands around New York City, living the unpredictable life of a working musician. The income was irregular, sometimes feast, sometimes famine. Marino was passionate about his craft but struggled with the financial instability it brought. He was warm and expressive, teaching Ray to appreciate beauty and emotion in life. But he also showed Ray firsthand the anxiety that comes from financial uncertainty. Ray's mother was Dalio, whose maiden name was also Italian. She worked as a homemaker but took various jobs to help stabilize the family finances. She was practical, organized, and focused on security. She worried constantly about money and their future. She wanted Ray to have the stability that Marino's music career couldn't provide. She was the counterbalance to Marino's artistic temperament, always thinking ahead, always planning. She taught Ray to be responsible and to think about consequences. She showed him that love sometimes means worry and that worry comes from caring deeply. The Dalio household was modest but filled with music and conversation. Marino would practice his instruments at home, filling the apartment with jazz. He'd talk about the musicians he admired, the gigs he played, the places he performed. But underlying the music was always tension about money. And would discuss bills, expenses, what they could and couldn't afford. She'd talk about friends and relatives who had stable jobs, secure futures. She wanted that security for her family. This created a push and pull in young Ray's mind. On one side was passion and creativity. On the other was stability and security. Ray was an only child, which meant all parental attention and expectation focused on him. He didn't have siblings to share the pressure or compete with for resources. He got his parents' full love but also their full worry. Being an only child made him self-reliant from an early age. He learned to entertain himself, to think independently, to make his own decisions. He didn't have older siblings to learn from or younger ones to teach. He was figuring things out on his own, developing his own frameworks for understanding the world. The family's financial situation was lower middle class, constantly teetering between stability and struggle. They never went hungry, but money was always tight. Ray wore hand-me-downs from cousins. Vacations were rare. Every purchase required consideration. His mother clipped coupons and shopped carefully. His father took any gig he could get. Ray learned early that money meant freedom and that not having it meant stress. He saw how financial pressure affected his parents' relationship and their happiness. This planted a seed deep in his psyche. Money wasn't about greed or status. It was about autonomy and peace of mind. Ray attended PS 115, a public elementary school in Jackson Heights. He was a decent student but not exceptional. He wasn't the kid who raised his hand constantly or competed for teacher approval. He was more interested in understanding how things worked than in memorizing facts. He liked math because it had clear logic. He liked seeing patterns and solving puzzles. but traditional schooling felt constraining to him. Sit still, memorize, regurgitate, repeat. It didn't match how his mind naturally worked. He was curious about the real world, not just textbook theories. What fascinated young Ray was how things connected. He noticed that when the price of something went up, people bought less of it. He observed that seasons affected what was available and what things cost. He saw patterns in the world that others seemed to ignore. His mind naturally looked for cause and effect relationships. If this happens, then that happens. He started building mental models of how systems worked. This wasn't something anyone taught him. It was just how his brain processed information. At age 12, Ray got his first job caddying at the Links Golf Club in Roslyn, Long Island. This was 1961, and caddying was one of the few jobs available to kids his age. He'd wake up early on weekends and summers, take the train and bus to the golf course, and carry bags for wealthy businessmen. The job paid about $5 per round, decent money for a kid. But the real education wasn't the money. It was exposure to a completely different world than Jackson Heights. The men Ray caddied for were successful investors, executives, and business owners. They talked openly about stocks, markets, investments, and business deals as they played golf. Ray was invisible to them, just the kid carrying their clubs. So they spoke freely, never thinking he was listening and learning. But Ray absorbed everything. He heard them discuss which stocks they were buying and why. He heard them analyze companies and predict market movements. He heard them talk about money in a way nobody in his neighborhood ever did. Not as something to worry about, but as something to grow and deploy strategically. One conversation changed everything. Ray overheard investors discussing a company called Northeast Airlines. The stock was trading at about $5 per share. The investors believed it was undervalued and would rise. Ray had saved about $300 from caddying. Instead of keeping it in his drawer or spending it on typical kid things, he decided to invest. He called a broker and bought shares of Northeast Airlines. He didn't really understand what he was doing. He was mimicking the successful men he caddied for. He was testing whether their approach actually worked. Within months, Northeast Airlines was acquired by another company. The stock price tripled. Ray's $300 became $900. He had tripled his money in less than a year. For a 12-year-old in 1961, this was a fortune. But more importantly, it was proof. The stock market wasn't just gambling or luck. There were patterns, logic, cause and effect. If you understood the system, you could predict outcomes. If you could predict outcomes, you could make money. And making money meant independence. It meant not living with the financial anxiety he saw in his parents' eyes. This first investment success was probably partly luck. Ray didn't have sophisticated analysis skills at age 12. He didn't understand financial statements or competitive dynamics. He just copied what successful people were doing. But luck or not, it hooked him. He became obsessed with understanding markets. He started reading the Wall Street Journal, which his father would bring home occasionally. He studied stock tables, trying to find patterns in the numbers. He read whatever investment books he could find at the library. He was teaching himself about a world that school never mentioned. Through his teenage years, Ray continued caddying and investing. He'd save his caddying money and put it into stocks. Sometimes he won, sometimes he lost. But each trade taught him something. He kept notebooks tracking his investments and observations. He'd write down why he bought, what he expected to happen, what actually happened, and what he learned. He was building his own education from scratch. School taught him math and history. The golf course and the market taught him how the world actually worked. By high school, Ray was known as the kid who played the stock market. Most teenagers in Jackson Heights in the mid-1960s were thinking about cars, sports, and dates. Ray thought about those things too, but he was more interested in markets and investing. He wasn't antisocial, but he was different. He had discovered something that gave him purpose and direction. While his peers were figuring out who they were, Ray had already found his calling. Ray attended LaGuardia High School, but he wasn't particularly engaged academically. His grades were mediocre, mostly BS and CS. He did what was required but no more. His real education was happening outside school. He was reading investment books, tracking stocks, and learning through doing. The disconnect between school and real-world learning frustrated him. School felt like jumping through hoops. Markets felt like solving puzzles that mattered. One led to grades that didn't mean much. The other led to money and understanding. During high school, Ray worked various jobs beyond caddying. He mowed lawns, shoveled snow, did odd jobs in the neighborhood. Every dollar earned went either to immediate needs or to his growing investment fund. He lived frugally, not because his family demanded it but because he was building toward something. He had seen the stress that financial dependence created. He wanted independence. He wanted to never have to worry about money the way his mother did. The path to that freedom was through understanding and mastering markets. In 1967, Ray graduated high school and enrolled at C.W. Post College of Long Island University. It wasn't a prestigious school. His grades weren't good enough for elite universities, and his family couldn't afford expensive tuition anyway. C.W. Post was affordable and close enough to commute from home. Ray wasn't choosing a college for its reputation. He was choosing a place where he could get a degree while continuing his real education in markets. Ray majored in finance, the obvious choice given his existing obsession. But he found most classes disappointingly theoretical. Professors taught models and formulas that assumed markets behaved rationally and predictably. But Ray's actual investing experience had taught him markets were messy, emotional, and often irrational. The gap between academic theory and market reality was enormous. Ray learned to take what was useful from classes and ignore the rest. He was becoming skilled at extracting value from any source while maintaining his own independent thinking. College in the late 1960s was a time of massive cultural upheaval. The Vietnam War was raging, protests were everywhere, the counterculture was challenging traditional values. But Ray wasn't particularly political or countercultural. He wasn't burning draft cards or joining protests. He was focused on understanding economic systems and market patterns. While his peers debated politics and society, Ray was studying commodity markets and economic cycles. He was building expertise while others were finding themselves. During college, Ray continued investing with increasing sophistication. He moved beyond simple stock picking to studying commodities and futures. Commodities fascinated him because they had clear supply and demand dynamics. If there was a drought, grain prices rose. If there was oversupply, prices fell. These cause and effect relationships were more transparent than stock markets. Ray started developing frameworks for predicting commodity price movements. He was moving from copying others to developing his own analytical approach. Ray also discovered he had a talent for seeing patterns others missed. He'd noticed that certain economic indicators preceded market movements. He'd see how different markets and asset classes related to each other. He was building a mental model of how the entire economic machine worked. This wasn't something taught in any single class. It was synthesis across economics, finance, history, psychology, and current events. Ray was becoming a systems thinker, seeing the forest instead of just trees. In 1971, Ray graduated from C.W. Post with a degree in finance. His grades were decent but not outstanding. He had learned more from markets than from classes. But he had the credential he needed. Now came the question of what to do next. Many of his classmates went to work for banks or brokerage firms in entry-level positions. But Ray wanted something different. He wanted to keep learning, to deepen his understanding. He decided to pursue graduate education, specifically an MBA. Ray applied to Harvard Business School, one of the most prestigious MBA programs in the world. His undergraduate grades were mediocre, and C.W. Post wasn't a feeder school for Harvard. But Ray had something unique on his application. He had been actively investing for nearly a decade. He had real trading experience and market knowledge beyond what most MBA applicants possessed. He wrote about his approach to understanding markets as systems. Somehow, Harvard saw something in this working-class kid from Queens. They admitted him to the MBA program starting in fall 1972. Getting into Harvard was transformative for Ray. It wasn't just about the credential, though that mattered. It was about access. Harvard Business School brought together the smartest, most ambitious students from around the world. It attracted professors who were thought leaders in their fields. It connected students to powerful networks in business and finance. For a kid from Jackson Heights, this was access to a world that had previously been distant and theoretical. Ray was now inside the machine he had been trying to understand from the outside. Ray arrived at Harvard in fall 1972. He was 23 years old, the son of a jazz musician and a homemaker, surrounded by classmates from wealthy families and elite undergraduate schools. He felt the class difference acutely. His classmates talked about family businesses and connections. Ray talked about caddying and Queens. But he also knew he had something they didn't. He had spent over a decade actually investing and learning from real successes and failures. Many of his classmates had impressive resumes but limited practical experience. Harvard Business School used the case method, where students analyzed real business situations and debated solutions. Ray thrived in this environment. The case method matched how his mind worked. Look at a situation, identify the key variables, understand the cause and effect chains, predict the outcome. This was exactly what he did when analyzing markets. Ray became known for his analytical rigor and willingness to challenge conventional thinking. He wasn't trying to impress professors or fit in. He was genuinely trying to understand the truth about how things worked. Ray was particularly influenced by Professor George Baker, who taught finance. Baker emphasized understanding businesses and markets deeply rather than relying on formulas. He encouraged students to develop their own frameworks based on first principles rather than accepting received wisdom. This resonated completely with how Ray thought. He wasn't interested in what everyone believed. He was interested in what was actually true. Baker gave Ray permission to trust his own thinking even when it contradicted consensus. During his time at Harvard, Ray also met his future wife, Barbara. She was working as a secretary at Harvard Business School. Ray was drawn to her groundedness and practicality. Barbara came from a more stable family background than Ray. She valued security and planning, similar to Ray's mother but without the anxiety. She was smart, organized, and supportive. She understood that Ray was driven by something bigger than just making money. He wanted to understand how the world worked. Barbara became his partner not just in life but in his journey of discovery. Ray graduated from Harvard Business School in 1973 with his MBA. He was now 24 years old with elite credentials to match his decade of practical experience. The combination was powerful. He could speak the language of finance professionals while also bringing real market knowledge. He had multiple job offers from investment banks and trading firms. The conventional path would be joining a prestigious firm, working his way up, eventually making partner. This was what most Harvard MBAs did. But Ray had a different instinct. He wanted to trade commodities and futures, which were less prestigious than stocks but more interesting to him. Commodities had clear fundamental drivers. If you understood supply and demand dynamics, you could predict price movements. Ray believed commodity markets were more transparent and logical than stock markets. He took a job at Dominick & Dominick, a small brokerage firm that traded commodities and gave him room to develop his own strategies. At Dominick & Dominick, Ray worked as director of commodities. He was responsible for advising clients on commodity investments and trading the firm's capital. He was finally doing full-time what he had been learning part-time since age 12. He dove deep into commodity markets, studying everything from cattle and grain to metals and oil. He built models to predict price movements based on supply, demand, weather, economic conditions, and other factors. He was refining the frameworks he had started developing in college. Ray's approach was different from most commodity traders. Many traders relied on technical analysis, looking at price charts and patterns. Others relied on gut instinct and experience. Ray was building fundamental models based on understanding the actual economics of each commodity. How much wheat was planted? What was the weather forecast? How much demand was expected? He was treating commodities as puzzles to solve rather than bets to take. This systematic approach gave him an edge over traders who relied on intuition alone. In the mid-1970s, commodity markets were volatile. The oil crisis of 1973 had shocked the world economy. Inflation was rising, affecting all commodity prices. Traditional investment strategies weren't working well. But for someone who understood commodities fundamentally, this was opportunity. Ray's models were predicting price movements with reasonable accuracy. His trades were profitable. He was gaining confidence in his approach and his ability to understand complex systems. But working at Dominic also showed Ray the limits of working for someone else. He had ideas about how to trade and analyze markets that didn't fit the firm's standard practices. He wanted to experiment with different strategies and take positions based on his models. But he had to follow firm rules and get approval for his ideas. He was constrained. The entrepreneurial spirit that had driven him since age 12 was frustrated by corporate structure. He started thinking about working for himself. In 1974, something happened that would prove crucial to Ray's future. He was at a cocktail party in New York when he met a man named Giscard d'Estaing. The man mentioned casually that his cousin was Valéry Giscard d'Estaing, who was about to become president of France. This random connection led to Ray being invited to France as a translator for his new acquaintance who was starting a business there. Ray saw this as an adventure and a learning opportunity. He took a leave from his job and went to France for several months. In France, Ray didn't just translate. He observed how European markets worked. He studied the French economy and how it differed from America. He saw firsthand how currency exchange rates affected trade and investment. He learned about central bank policies in Europe versus the United States. This international exposure broadened his understanding of global economics. He began seeing markets not as isolated systems but as interconnected parts of a global machine. What happened in one country affected others. Currency movements created opportunities across borders. When Ray returned to New York, he brought back expanded perspective and ambition. He was more confident in his ability to understand complex economic systems. He was more convinced that his systematic approach could work across different markets and geographies. He was also more certain that he needed to work for himself. He needed the freedom to pursue his ideas without constraint. In 1975, at age 26, Ray Dalio made the decision that would define his life. He left Dominic and founded his own company. Ray started Bridgewater Associates from his two-bedroom apartment in Manhattan. The name came from wanting something that sounded established and trustworthy. Associates suggested multiple people even though it was just Ray. The office was literally his apartment. The Bloomberg terminal was in his living room. His filing cabinets were in his bedroom. Barbara was supportive but practical. They were newly married, and Ray was leaving a steady job to start a one-person firm with no guaranteed income. It was risky. But they both believed in Ray's ability and his approach. Initially, Bridgewater wasn't an investment fund. Ray didn't have enough capital to manage and generate meaningful fees. Instead, Bridgewater was a consulting and research service. Ray would analyze commodity markets and economic trends, then sell his analysis to clients. He'd advise corporate clients on how to manage commodity price risk. If a company used a lot of copper, Ray would help them hedge their copper price exposure. If a grain processor needed to lock in prices, Ray would advise on futures contracts. He was being paid for his knowledge and analytical ability, not for managing capital. This consulting model was perfect for Ray's development. He had to deepen his expertise to provide valuable advice. He had to explain his reasoning clearly to clients. He had to be right consistently or clients would leave. This forced discipline and rigor into his thinking. He couldn't rely on luck or vague intuition. He had to have clear frameworks and logical reasoning. Every client engagement made him sharper and more systematic in his approach. Ray also started publishing research reports on commodity markets and economic trends. These reports analyzed supply and demand fundamentals, predicted price movements, and explained the reasoning behind predictions. The reports became popular among traders, portfolio managers, and corporate risk managers. People appreciated Ray's clear thinking and systematic approach. His reputation started growing beyond his immediate client base. The research reports were marketing even though Ray didn't think of them that way. They demonstrated his expertise and attracted new clients. One of Ray's early clients was McDonald's. The fast food chain was worried about chicken price volatility. McNuggets were becoming a major product, but chicken prices fluctuated significantly. McDonald's wanted to hedge their chicken exposure but didn't know how. There wasn't a liquid chicken futures market. Ray helped them structure a creative hedging strategy using related commodities and contracts. This work showed Ray's ability to solve real business problems using his understanding of markets. It wasn't just theoretical. It created actual value. As Bridgewater grew, Ray hired his first employees. He needed help with research, client service, and operations. He looked for people who were smart, curious, and willing to challenge conventional thinking. He didn't want employees who just followed orders. He wanted people who would push back, question assumptions, and help him think more clearly. This was the beginning of Bridgewater's unique culture. Ideas mattered more than hierarchy. Truth mattered more than politeness. Getting to the right answer mattered more than protecting egos. By the late 1970s, Bridgewater had several employees and a growing client base. The firm was profitable and stable. But Ray wanted to do more than consulting. He wanted to manage capital and implement his investment strategies at scale. Consulting proved his expertise, but investing would test whether his approach actually created alpha. In 1979, Ray decided to transition Bridgewater from consulting firm to investment manager. He started raising capital from clients who trusted his analysis to let him manage their money. The timing was significant. In 1979, Paul Volcker became chairman of the Federal Reserve. Inflation was out of control, running over 13% annually. The economy was struggling with stagflation, combining stagnant growth with high inflation. Volcker decided to break inflation by dramatically raising interest rates. In 1980 and 81, the Fed raised rates to unprecedented levels, with the federal funds rate eventually exceeding 19%. This policy would cause a severe recession but would also break the back of inflation. Ray saw this coming. His economic models predicted that Volcker's policies would cause near-term pain but eventual recovery. He positioned Bridgewater's investments accordingly. He bet against bonds initially as rates rose, then bet on bonds and stocks once he believed the recession would end and disinflation would begin. His timing wasn't perfect, but his framework was sound. Bridgewater's investments performed well during this turbulent period. Clients who had trusted Ray with their capital were rewarded. His reputation as an investor, not just consultant, began to solidify. The early 1980s also brought personal changes. Ray and Barbara had their first child, a son named Devon. Becoming a father made Ray think differently about his work. It wasn't just about proving his theories anymore. He was building something to provide for his family. He wanted to create lasting wealth and security, not just for himself but for Barbara and Devon. The financial anxiety he had seen in his parents' home would not be replicated in his own. He was determined to succeed not just intellectually but financially. However, success brought overconfidence. By 1981, Ray was sure he understood how the economy and markets worked. He had successfully predicted major trends. His investment performance was strong. He became convinced that a massive economic depression was coming. He believed the debt levels in the economy were unsustainable and that a deflationary collapse similar to the 1930s was inevitable. He positioned Bridgewater's investments for depression. He bet heavily on falling stock prices and economic collapse. He was spectacularly wrong. What Ray didn't understand was that modern central banks had learned from the 1930s. They knew how to prevent deflationary spirals. Volcker's Fed cut rates once inflation was controlled. The economy recovered instead of collapsing. The stock market soared through the 1980s. Ray's depression bets lost money. His clients lost money. His reputation was damaged. By 1982, Bridgewater was in serious trouble. The firm had to lay off employees. Ray couldn't make payroll. At one point, Ray had to borrow $4,000 from his father to cover expenses. The same father whose financial insecurity had haunted Ray his entire childhood. This failure devastated Ray. His entire identity was built around understanding how markets worked. He had been wrong about the biggest call of his career. He had lost client money. He had nearly destroyed the firm he built. He questioned everything. Maybe his approach wasn't as good as he thought. Maybe he didn't understand markets as well as he believed. Maybe he should give up and get a regular job. It was the lowest point of his life, both professionally and psychologically. But failure taught Ray lessons that success never could. He realized he had been overconfident. He had believed his model was complete when it was actually incomplete. He hadn't considered alternative scenarios carefully enough. He had bet too heavily on a single view without adequate risk management. He had let ego and conviction override prudent caution. The pain of this failure was so intense that Ray became determined never to make those same mistakes again. He needed to change his approach fundamentally. Ray decided to rebuild Bridgewater around principles that would prevent catastrophic errors. First, he would always consider multiple scenarios, not just his base case. What if he was wrong? What would the world look like in different scenarios? Second, he would never bet everything on a single view. He would diversify across different strategies and scenarios. Third, he would systematically seek out people who disagreed with him to stress test his thinking. Fourth, he would document his decision-making process so he could learn from both successes and failures. Fifth, he would create algorithms and systematic rules to remove emotion from investing. This transformation from intuitive trader to systematic investor became the foundation of everything Bridgewater would build. Ray became obsessed with creating investment systems that didn't depend on his brilliance or intuition. Systems that would work even if he was wrong about specific predictions. Systems that balanced multiple scenarios. Systems that were transparent and improvable. He was building an investment machine, not just placing bets. This shift from discretionary to systematic thinking would prove to be Ray's greatest innovation. Ray also developed what he called radical transparency. He believed that the best ideas win when people can speak openly without fear. At most investment firms, junior employees don't challenge senior leaders. People protect their egos and reputations. Mistakes get hidden rather than examined. Ray decided Bridgewater would be different. Anyone could challenge anyone, regardless of rank. All meetings would be recorded. Mistakes would be examined openly. The goal was always finding truth, never protecting feelings. This was uncomfortable and alien to most corporate cultures, but Ray believed it was essential for learning and improving. The 1982 failure paradoxically saved Bridgewater by forcing this transformation. A firm that never failed might have continued with flawed approaches. The pain of near death made Ray humble and hungry to improve. He emerged from the crisis with better systems, better processes, and better culture. He had learned that being smart wasn't enough. You needed systems that made you less stupid. You needed processes that prevented catastrophic errors. You needed culture that prioritized truth over ego. By the mid-1980s, Bridgewater was recovering. Ray had retained some clients who believed in him despite the losses. He was implementing his new systematic approach. Instead of making big concentrated bets, he was building diversified portfolios that balanced multiple scenarios. He created what he called risk parity strategies, which allocated capital based on risk contribution rather than dollar amounts. He developed algorithms to identify market patterns and generate trading signals. He was moving from artist to engineer, from intuition to system. In 1985, Ray met Bob Prince and Greg Jensen, two men who would become crucial to Bridgewater's future. Bob was older than Ray, a successful investor who shared Ray's systematic thinking. Greg was younger, brilliant and curious, excited by the challenge of building investment systems. Both were attracted to Ray's culture of radical transparency and systematic thinking. They didn't want to work at typical Wall Street firms where politics mattered more than performance. They wanted to be part of building something different. Bob and Greg became Ray's thought partners. The three of them would spend hours debating economic theories, testing models, and challenging each other's thinking. This was exactly what Ray wanted. People who would tell him when he was wrong. People who could improve his thinking rather than just executing his orders. The collaborative dynamic between Ray, Bob, and Greg became the engine that drove Bridgewater's intellectual development. They made each other smarter through constant challenge and debate. Through the late 1980s, Bridgewater refined its systematic approach. The firm developed models to predict currency movements, interest rate changes, commodity prices, and stock market performance. These models were based on understanding fundamental economic relationships. If growth was accelerating, what happened to inflation, interest rates, and stock prices? If the Fed was tightening, how did that affect different asset classes? Ray and his team were building a comprehensive model of how the global economic machine worked. They called it the economic machine. Ray also wrote extensively about his frameworks. He created internal documents explaining his understanding of economic cycles, credit dynamics, currency relationships, and market behavior. These weren't just theoretical essays. They were practical guides that could be turned into trading algorithms. Ray believed that if you truly understood something, you could code it into a systematic rule. If you couldn't code it, you didn't understand it well enough. This forced clarity and rigor into Bridgewater's thinking. One of Ray's key insights was about debt cycles. He realized that economies move in long-term cycles driven by credit expansion and contraction. When credit is easy, people borrow and spend, driving growth. But debt accumulates. Eventually, debt service becomes unsustainable. Then comes deleveraging, where debt is reduced through some combination of austerity, defaults, inflation, or wealth redistribution. Ray studied debt cycles throughout history, from the 1920s and 30s to Latin American debt crises to the Japanese bubble. He developed a framework for understanding where economies were in their debt cycles and what came next. This debt cycle framework became central to Bridgewater's investment process. If you understood where an economy was in its debt cycle, you could predict with reasonable confidence what policies would be implemented and what would happen to different asset classes. An economy in early expansion behaves differently than one struggling with debt overhang. Ray's systematic approach to debt cycles gave Bridgewater an edge in macro investing. They weren't guessing. They were applying a framework refined over decades and tested against historical data. By the early 1990s, Bridgewater was managing significant capital for institutional clients. Pension funds, endowments, and sovereign wealth funds trusted Bridgewater to manage portions of their portfolios. The firm had proven that its systematic approach generated consistent returns with controlled risk. Bridgewater's flagship fund, Pure Alpha, was delivering double-digit returns with lower volatility than stock markets. The risk parity strategies were helping clients achieve better portfolio diversification. Bridgewater was becoming known as a sophisticated institutional manager, not just a commodity trading advisor. The 1990s also brought new challenges and opportunities. The Cold War ended, transforming global economics. China was emerging as a manufacturing powerhouse. Technology was revolutionizing business and finance. The internet was creating new possibilities and bubbles. Alan Greenspan's Fed was managing the economy with new tools. Each of these developments required Bridgewater to update its understanding and models. The world was changing fast, and investment frameworks had to evolve with it. Ray became particularly interested in China. He saw that China's economic rise would transform the global economy over coming decades. Most American investors ignored China or viewed it with suspicion. Ray took a different approach. He traveled to China repeatedly, met with government officials and business leaders, studied Chinese history and culture. He wanted to understand China deeply, not superficially. He believed understanding China was essential to understanding global economics in the 21st century. This early interest in China gave Bridgewater advantages as China's importance grew. In the late 1990s, the technology bubble inflated. Internet stocks with no profits were valued at billions. Traditional valuation metrics were dismissed as obsolete. A new paradigm was supposedly here. Ray was skeptical. His framework said valuations were unsustainably high. But he also remembered 1982 when he had been sure he was right and the market was wrong. He had learned humility. So instead of betting everything on the bubble popping, Bridgewater positioned for multiple scenarios. If the bubble continued, they'd participate somewhat. If it popped, they'd be protected. This balanced approach kept Bridgewater profitable through both the bubble's rise and its eventual collapse. The year 2000 brought the crash Ray had expected. The Nasdaq fell 78% from peak to trough. Trillions of dollars of wealth evaporated. Many hedge funds and investors were wiped out. But Bridgewater's balanced approach meant the firm navigated the crash successfully. Ray's systematic framework had worked. By not overbetting on any single outcome, Bridgewater avoided catastrophic losses. By having strategies that profited from volatility and change, the firm actually made money during the crash. Clients noticed. If Bridgewater could navigate the worst stock crash since the Depression with positive returns, maybe this systematic approach really worked. The early 2000s also brought personal tragedy. Ray's son Devin, who had struggled with mental health issues, died in a car accident in 2003. He was just 19 years old. The loss devastated Ray and Barbara. Ray had been so focused on building Bridgewater that he sometimes neglected family. The guilt and grief were overwhelming. Ray questioned whether his obsession with work had cost him precious time with his son. He went through intense therapy to process the trauma. The experience changed him, making him more reflective about meaning and purpose beyond just building a successful firm. The tragedy also reinforced Ray's belief in radical transparency and honest confrontation of reality. He had learned through therapy that avoiding painful truths doesn't make them go away. You have to face reality directly, no matter how painful. This personal lesson matched what Ray preached at Bridgewater. Don't hide from hard truths. Face them, process them, learn from them. The firm's culture of radical transparency became even more central after Devin's death. Ray was living his principles through the hardest test imaginable. By the mid-2000s, Bridgewater had become one of the largest hedge funds in the world. The firm managed over $30 billion. It employed hundreds of people. It had built sophisticated technology systems to implement its investment strategies. Pure Alpha, Bridgewater's flagship fund, had delivered 15% annualized returns for over 15 years. The risk parity strategies had billions in assets. Institutional clients saw Bridgewater as essential diversification. When stocks and bonds both fell, Bridgewater's strategies could still make money. Then came 2008, the global financial crisis. This was the biggest economic catastrophe since the 1930s. Major financial institutions failed or were bailed out. Lehman Brothers collapsed. AIG was rescued. The stock market fell nearly 60%. Global trade plummeted. Unemployment soared. Governments and central banks implemented unprecedented interventions. The entire financial system nearly froze. Many economists believed the world was facing another Great Depression. Ray had seen it coming. His debt cycle framework had predicted that unsustainable debt levels would lead to crisis. Bridgewater had positioned its portfolios defensively before the crisis hit. When the crash came, Bridgewater's Pure Alpha fund made 14% in 2008 while most hedge funds lost money and the stock market fell 37%. It was an extraordinary performance that validated everything Bridgewater had built. The systematic approach worked even in the worst crisis in 80 years. The 2008 crisis also gave Ray a platform to explain his economic framework to wider audiences. He wrote papers explaining the deleveraging process and what policies would be needed to navigate it. He briefed policymakers, including the Treasury Department and Federal Reserve. He explained that the deleveraging would take years and would require some combination of austerity, debt defaults, money printing, and wealth redistribution. He provided a roadmap for what was happening and what would happen next. His framework was playing out in real time. Ray became known not just as a successful investor but as an economic thinker who understood crises better than most. His template for understanding deleveraging became widely cited. Policymakers, economists, and investors wanted to understand how Ray thought about the crisis. Bridgewater published research explaining the economic machine, debt cycles, and deleveraging dynamics. This research was read by central bankers, finance ministers, and institutional investors worldwide. Ray had become an influential voice on global macroeconomics. The crisis also reinforced Bridgewater's culture and principles. Many firms had hidden problems and shifted blame during the crisis. Bridgewater was radically transparent about its positions, reasoning, and performance. The firm held meetings where employees could challenge leadership's decisions. Ray encouraged people to point out where Bridgewater had been wrong or could improve. This culture of truth-seeking and continuous improvement made Bridgewater stronger while other firms were weakened by crisis. After the crisis, Bridgewater continued to grow. By 2010, the firm managed over $60 billion. By 2015, it managed over $150 billion. Bridgewater became the largest hedge fund in the world. The size brought new challenges. How do you maintain culture and performance while growing to massive scale? How do you preserve the principles that made you successful when you have thousands of employees? Ray spent enormous energy on codifying Bridgewater's culture and principles. In 2011, Ray formalized his thinking into a document called Principles. This was a collection of hundreds of principles covering everything from how to make decisions to how to have difficult conversations to how to build organizations. Ray had been writing down his principles for decades. Now he organized them into a comprehensive operating manual for life and work. The Principles document eventually became a best-selling book in 2017, introducing Ray's philosophy to millions beyond the investment world. The principles were radical in many ways. Be radically open-minded. Put our honest thoughts out on the table for everyone to see. Don't let loyalty to people stand in the way of truth. Create a culture where it's okay to make mistakes but unacceptable to not learn from them. These ideas contradicted how most organizations operated. But Ray believed they were essential for any organization that wanted to achieve excellence. Culture wasn't just about being nice. It was about creating systems that helped groups find truth and make better decisions. Ray also became increasingly focused on succession. He was getting older and wanted to ensure Bridgewater would outlive him. He promoted younger leaders like Greg Jensen and David McCormick. He created co-CEO structures to distribute leadership. He tried various organizational structures to transition from founder-led to institution. This proved harder than anticipated. Ray's personality and thinking were so central to Bridgewater that removing him from daily operations was like trying to remove the engine from a moving car. The succession process would take years and involve many experiments and adjustments. In 2017, Ray stepped back from day-to-day management. He remained chairman and mentor but let others run operations and investments. Bridgewater continued performing well, managing over $160 billion. The systematic approaches Ray had built proved durable even without his constant involvement. The algorithms and frameworks operated independently. The culture of radical transparency and truth-seeking was embedded institutionally. Bridgewater had successfully transitioned from founder-led startup to enduring institution. Looking back on Ray's journey reveals several remarkable things. First, he identified his calling at age 12 and pursued it with singular focus for over 50 years. The obsession that seemed weird in high school became the foundation of extraordinary achievement. Second, he learned more from failure than success. The 1982 near-death experience transformed him from overconfident trader to systematic investor. Third, he built an organization around principles, not just making money. Culture, transparency, and truth-seeking were as important as returns. Fourth, he continuously evolved his thinking based on new information and experiences. He never assumed he had it all figured out. Ray's secret advantage wasn't genius IQ or insider connections. It was systematic thinking, radical open-mindedness, and willingness to learn from mistakes. He built systems that made him less stupid rather than relying on being smart. He created culture that challenged his thinking rather than reinforcing it. He studied history to understand patterns rather than assuming this time was different. He approached investing as an engineering problem to solve rather than a game to win. These meta-approaches proved more durable than any specific strategy or insight. Ray also benefited from timing and luck. He came of age when markets were less efficient and information advantages still existed. He built Bridgewater before massive amounts of capital chased similar strategies. He navigated crises that validated his frameworks. He met partners like Bob Prince and Greg Jensen who complemented his thinking. He had the financial success that bought time to develop his approaches without pressure to conform to industry norms. Skill and hard work mattered enormously, but fortune also played its part. Today, Bridgewater manages over $150 billion and employs about 1,500 people. The firm has generated over $50 billion in profits for clients over its history. Pure Alpha has delivered annualized returns around 12% net of fees over more than 30 years. The risk parity strategies manage over $100 billion. Bridgewater is cited in academic research on systematic investing, risk management, and organizational culture. Ray has been named one of the most influential people in finance by multiple publications. His book Principles has sold millions of copies worldwide. But perhaps Ray's greatest contribution isn't his investment performance or firm size. It's his frameworks for thinking about economics, decision-making, and organization building. The economic machine template helps people understand business cycles and policy impacts. The principles for radical transparency and truth-seeking offer an alternative to typical corporate cultures. The systematic approaches to investing demonstrate how to reduce human bias and error. The emphasis on learning from failures and maintaining intellectual humility provides a model for continuous improvement. These ideas have influenced investors, business leaders, and thinkers far beyond Bridgewater. Ray's story also offers lessons about the path to mastery. He found his passion early and committed completely. He pursued unconventional education, learning more from markets than textbooks. He failed spectacularly and used failure as fuel for reinvention. He built systems and culture to compensate for human limitations. He documented his thinking so others could learn and improve it. He remained curious and humble despite massive success. He viewed investing not as a way to get rich but as a way to understand how the world works. The money was a byproduct of understanding. The journey from caddying at age 12 to building the world's largest hedge fund took over 50 years of obsessive focus. There were no shortcuts. Ray worked constantly, thought constantly, learned constantly. He read voraciously across economics, history, psychology, and philosophy. He traveled to understand different economic systems. He engaged with people who thought differently. He wrote down his observations and tested them against reality. He built technology to implement his ideas systematically. He created an organization that would continue learning after him. The accumulation of small improvements over decades created something extraordinary. What made Ray different from other smart, ambitious people? Perhaps it was the combination of intellect and humility. He was smart enough to develop sophisticated frameworks but humble enough to know he could be wrong. He was confident enough to trust his judgment but paranoid enough to systematically check that judgment. He was independent-minded but actively sought out disagreement. He was passionate about being right but even more passionate about learning where he was wrong. These balances are rare. Most people tilt too far toward confidence or caution, independence or conformity, passion or detachment. Ray's story also illuminates the role of pain in growth. His childhood financial anxiety drove his initial obsession with markets. The 1982 failure forced him to rebuild his entire approach. His son's death made him confront what really mattered. Each painful experience contained lessons that success never taught. Ray developed the practice of pain plus reflection equals progress. When something hurts, don't avoid it. Reflect on it deeply. Extract the lesson. Use the pain to grow. This principle applies to investing, business, relationships, and life. Progress requires confronting hard truths. The culture Ray built at Bridgewater is perhaps his most controversial contribution. Radical transparency means recording meetings, allowing anyone to challenge anyone, and making people's strengths and weaknesses explicit. Many people find this environment uncomfortable or even toxic. Critics argue it enables conflict and undermines psychological safety. Defenders argue it creates genuine meritocracy and faster learning. The truth is probably that it works for some people and not others. Ray built a culture that fit his personality and philosophy. It attracted people who thrived in that environment and repelled others. Not every organization should copy Bridgewater's culture, but every organization should think carefully about what culture serves its mission. Ray's economic frameworks have also faced criticism. Some economists argue his debt cycle template is overly simplified and doesn't account for institutional and structural differences across countries and eras. Others say his template worked well for the 2008 crisis but might not generalize. Fair critiques. But Ray would likely agree. He never claimed his models were complete or perfect. He claimed they were useful frameworks for thinking about complex systems. They were tools to reduce uncertainty, not eliminate it. Every model is wrong, but some models are useful. Ray's frameworks proved useful enough to generate extraordinary returns and influence policy discussions. Looking at Ray's investment performance over 5 decades, what's striking is the consistency. Pure alpha has had very few down years. The drawdowns have been shallow. The volatility has been lower than equity markets. This consistent performance across different economic environments validates the systematic approach. Bridgewater isn't right about everything or perfectly predictive. But the diversification across strategies, scenarios, and asset classes creates a portfolio that performs in most environments. This is the power of systematic thinking over concentrated bets. Ray's influence extends beyond investing into broader economic policy discussions. Central bankers and Treasury officials have consulted him during crises. His papers on deleveraging and debt cycles inform policy debates. His framework for understanding China's economy helps investors and policymakers navigate the most important economic relationship of the 21st century. Ray operates at the intersection of markets, policy, and economic theory. Few investors have shaped thinking in all 3 domains. The Bridgewater story is also a story about the evolution of finance. When Ray started in the 1970s, investing was mostly discretionary. Portfolio managers used judgment, experience, and intuition. Systematic approaches were limited by technology and data availability. Over Ray's career, finance became increasingly quantitative and systematic. Computers could process vast amounts of data. Algorithms could execute strategies faster than humans. Machine learning could identify patterns invisible to human analyses. Bridgewater was at the forefront of this transformation from art to science. Today's investment industry is far more systematic, and Ray's work helped drive that evolution. But Ray also understood that pure quantification has limits. Markets involve human behavior, which is often irrational and unpredictable. Political decisions affect economics, and politics is messy. Structural changes create new dynamics that historical data doesn't capture. So Bridgewater's approach combines quantitative rigor with qualitative judgment. Algorithms generate signals, but humans make final decisions. Historical patterns inform probabilities, but decision-makers consider whether this time might be different. The synthesis of systematic and discretionary thinking is where Bridgewater lives. Ray's personal evolution is also instructive. The young man who started investing at 12 was brilliant but overconfident. The entrepreneur who founded Bridgewater at 26 was ambitious but naive. The investor who nearly failed at 33 was humbled and transformed. The leader who built a culture of radical transparency was shaped by personal pain and professional failure. The elder statesman who transitioned from daily management was finally at peace with not controlling everything. Each stage built on previous lessons. Ray at 75 understood things Ray at 25 couldn't imagine. What will Ray's legacy be? In terms of direct impact, he built one of the most successful investment firms in history. Bridgewater's returns have enriched clients and proved that systematic approaches work. The firm employs hundreds of people and manages assets for institutions worldwide. In terms of intellectual impact, Ray's frameworks for understanding debt cycles, economic machines, and policy responses have influenced economists, policymakers, and investors. His principles for decision-making and organizational culture have shaped how leaders think about building teams and companies. His emphasis on radical transparency and learning from failure offers an alternative to conventional corporate approaches. Perhaps most importantly, Ray demonstrated that sustained excellence in complex domains requires systems that overcome human limitations. We're all biased, emotional, and prone to errors. But we can build processes that catch our mistakes, cultures that challenge our thinking, and tools that extend our capabilities. The path to mastery isn't about being a genius. It's about creating an environment where you become less stupid over time. This lesson applies far beyond investing. It applies to any field where decisions under uncertainty determine outcomes. Ray's story also affirms the value of long-term thinking. In a culture obsessed with quick success and instant gratification, Ray spent 50 years building and refining his craft. His first decade was learning and failure. His second decade was rebuilding systematically. His third decade was proving the approach worked. His fourth decade was scaling and institutionalizing. His fifth decade was succession and legacy. Each decade built on previous work. There were no shortcuts. The compound effect of consistent improvement over decades created something extraordinary. Patience and persistence mattered more than brilliance. The decision to start Bridgewater from his apartment in 1975 was audacious. Ray had no investors, no track record, no safety net. He had conviction in his approach and willingness to bet his life on it. That decision shaped everything that followed. It gave him freedom to pursue his ideas without constraint. It forced him to develop discipline and rigor because failure was his alone. It allowed him to build culture from scratch rather than trying to change an existing organization. The freedom of entrepreneurship enabled everything Bridgewater became. This freedom had costs, including the near-death experience in 1982. But Ray believed the costs were worth it. Freedom to think independently and act on those thoughts was priceless. Ray's relationship with Barbara also deserves recognition. She supported his decision to leave steady employment and start a firm from their apartment. She managed their household while he built the business. She stood by him through the near failure in 1982. She grieved with him after their son's death. Behind every great achievement is usually a partner who makes it possible. Barbara was that partner for Ray. Her stability and support provided the foundation that let him take risks and pursue unconventional paths. The story of Bridgewater is also the story of their partnership. The next chapter of Bridgewater's story will reveal whether Ray successfully transitioned from founder-led to institutional firm. Many great companies fail to survive their founders. The culture becomes diluted, the edge is lost, the performance deteriorates. Bridgewater's systematic approaches should be durable because they're codified in algorithms and processes. But culture is harder to preserve. Will future generations of Bridgewater employees embrace radical transparency and truth-seeking? Will they maintain the same obsessive focus on understanding how things work? Will they continue evolving the frameworks Ray built? These questions will be answered over coming decades. Regardless of what happens to Bridgewater the institution, Ray's contributions to investing and organizational thinking are secure. He showed that systematic approaches can generate consistent returns across different market environments. He demonstrated that culture and principles matter as much as strategies. He proved that learning from failure is more valuable than celebrating success. He created frameworks for understanding economic cycles that help investors and policymakers navigate complexity. He built an organization that challenges conventional wisdom about transparency, hierarchy, and decision-making. These contributions will influence investors and leaders for generations. Ray's story ultimately affirms several truths about achievement and mastery. Find something you're passionate about and commit completely. Learn from failures more than successes. Build systems that make you less stupid over time. Surround yourself with people who challenge your thinking. Document your principles so you can improve them. Stay curious and humble no matter how successful you become. Think independently but actively seek disagreement. View setbacks as learning opportunities. Play the long game with patience and persistence. These aren't secrets or shortcuts. They're the unglamorous work of mastery accumulated over decades. Ray Dalio's journey from Queens to building the world's largest hedge fund demonstrates that ordinary humans can achieve extraordinary things through systematic thinking, radical open-mindedness, and relentless pursuit of truth. The systematic approach Ray developed at Bridgewater also revolutionized how institutional investors think about portfolio construction. Before Bridgewater's risk parity strategies became influential, most portfolios were built using traditional asset allocation. Typically 60% stocks and 40% bonds. This approach assumed stocks would drive returns while bonds provided stability. But Ray questioned why portfolios should be dollar-weighted rather than risk-weighted. Stocks are much more volatile than bonds, so a 60-40 portfolio actually has more than 90% of its risk in stocks. The bonds barely contribute to diversification on a risk-adjusted basis. Ray's risk parity approach allocated capital based on each asset's contribution to total portfolio risk. If stocks were 3 times more volatile than bonds, you'd hold 3 times as much in bonds as stocks to equalize their risk contributions. Then you could use modest leverage to amplify returns to desired levels. This approach created truly diversified portfolios where different asset classes contributed equally to risk and return. During periods when stocks fell, bonds and other assets could offset losses. The portfolio performed more consistently across different economic environments. This wasn't just theory. Bridgewater's all-weather fund implemented risk parity principles and delivered consistent returns through various market conditions. During the 2008 crisis, when traditional portfolios fell 30 to 40%, all-weather fell only single digits. During the recovery, it participated in gains. The consistency of risk parity performance attracted enormous institutional interest. By 2015, hundreds of billions of dollars were invested in risk parity strategies globally. Ray's innovation had transformed institutional portfolio management. The intellectual foundation for risk parity came from Ray's understanding of economic environments. He identified 4 main economic scenarios: growth rising with inflation low, growth rising with inflation high, growth falling with inflation low, growth falling with inflation high. Different assets performed best in different scenarios. Stocks did well when growth rose and inflation stayed moderate. Bonds did well when growth slowed. Commodities did well when inflation rose. By holding assets that performed in different scenarios, you created a portfolio that could weather any environment. This was the all-weather concept, a portfolio built to perform across all economic seasons. Ray's frameworks also influenced how investors think about alpha and beta. Traditional finance separated market returns, called beta, from manager skill, called alpha. Ray argued this separation was artificial. All returns come from exposure to risk factors. What matters is understanding which risk factors you're exposed to and whether you're compensated adequately for those risks. Pure Alpha, Bridgewater's flagship fund, aimed to generate returns uncorrelated with traditional market exposure. Not by avoiding risk but by balancing different types of risk so they offset each other. This created alpha that didn't depend on market direction. The Pure Alpha approach involved taking positions across global markets in currencies, bonds, stocks, and commodities. Some positions were long, betting prices would rise. Others were short, betting prices would fall. The positions were sized so the overall portfolio had no net exposure to general market direction. Instead, returns came from getting individual positions right. If Bridgewater correctly predicted that Japanese bonds would outperform German bonds, they'd profit regardless of whether global bond markets rose or fell. This alpha was pure in the sense that it wasn't contaminated by market beta. Building pure alpha strategies required sophisticated understanding of correlations across global markets. How do different assets relate to each other? How do those relationships change in different economic environments? Ray and his team built models mapping the correlation structure of global markets. They understood that correlations themselves change based on economic conditions. During risk-off periods, previously uncorrelated assets might move together. During calm periods, fundamentals drove individual market movements. The models had to account for these regime changes to generate true alpha. The technology infrastructure required to implement these strategies was massive. Bridgewater built proprietary systems to collect data from markets worldwide. Economic data, market prices, news feeds, everything relevant to investment decisions flowed into Bridgewater's systems in real time. Algorithms processed this information, generated signals, and executed trades across global markets. The firm employed hundreds of engineers and technologists to build and maintain these systems. Bridgewater was as much a technology company as an investment firm. Ray also pioneered the concept of believability-weighted decision-making. In most organizations, decisions are made hierarchically. The boss decides or decisions are made democratically with one person, one vote. Ray thought both approaches were flawed. Hierarchy gave too much weight to position rather than expertise. Democracy gave equal weight to people with vastly different knowledge and track records. Instead, Ray argued decisions should be weighted by believability. People with better track records and deeper expertise should have more influence on decisions in their domain. Someone who'd been right about currency markets for 20 years should have more say than someone new to the area. Implementing believability weighting required measuring track records systematically. Bridgewater created databases tracking everyone's predictions and decisions. When someone made a call about market direction or economic trends, it was recorded. When the outcome became clear, the accuracy was documented. Over time, each person built a believability score in different domains. Someone might be highly believable on monetary policy but less so on corporate earnings. The system created meritocracy based on actual results rather than credentials or seniority. This approach was controversial and uncomfortable. Having your believability scored and weighted felt like being constantly graded. Some people thrived in this environment, motivated by the transparency and fairness. Others found it stressful and alienating. Ray believed the discomfort was worth it. Ideas should win based on merit and track records, not politics or likability. Over time, this system would produce better decisions because the most knowledgeable people had appropriate influence. The question was whether the cultural costs outweighed the decision-making benefits. Ray's principles also addressed how to handle disagreements. In typical organizations, disagreements are often suppressed or resolved through compromise. Ray believed disagreement was valuable and should be explored deeply. When smart people disagree, it usually means both see something the other doesn't. The goal shouldn't be to compromise or have one person win. The goal should be to understand why you disagree and synthesize a view that incorporates both perspectives. This required techniques for productive disagreement. One technique Ray developed was the 2-minute rule. When you disagree with someone, you have to listen to their perspective for at least 2 minutes without interrupting. Really listen, trying to understand their reasoning and what they see that you don't. Then you can respond. This simple rule prevented the typical pattern where people argue past each other, each trying to score points rather than understand. The 2-minute rule forced genuine engagement with different viewpoints. Another technique was making disagreements explicit and recorded. At Bridgewater, when people disagreed on important questions, they'd document both perspectives and the reasoning behind each. Then they'd collect evidence over time about which view proved more accurate. This created institutional learning. The organization could see which types of reasoning worked and which didn't. Individuals could see their blind spots and calibrate their confidence. Disagreements became learning opportunities rather than conflicts to avoid. Ray also developed what he called the believability matrix. For any important decision, you'd identify the most believable people on that topic. Then you'd get their views and understand their reasoning. If highly believable people disagreed, you'd dig into why. What did each see that the other didn't? Could the views be synthesized? If not, which view had stronger logic and evidence? The matrix ensured decisions incorporated the best thinking available rather than just the loudest voice or highest rank. These decision-making principles extended beyond investing to all aspects of running Bridgewater. Hiring decisions, strategic choices, organizational structure, everything was subjected to the same systematic thinking. Who were the most believable people on organizational design? What did research and evidence say about effective team structures? How should we test different approaches and learn from results? Ray applied the same rigor to building the organization as to building investment strategies. The cultural intensity at Bridgewater was legendary. New employees often struggled with the radical transparency and constant feedback. Meetings were recorded and could be reviewed by anyone. Performance was discussed openly. Mistakes were examined in detail, not to punish but to learn. Personal development plans were explicit and tracked. Many people couldn't handle this environment. Turnover was significant, especially in early years. But those who stayed often became fierce believers. They felt they were learning and growing faster than anywhere else. They appreciated the meritocracy and honesty even when it was uncomfortable. Ray believed this culture was essential for achieving excellence at scale. Small organizations can rely on founder genius and informal communication. But as organizations grow, they need systems and culture to maintain quality. Most large organizations become bureaucratic and political. Decisions get made based on hierarchy and relationships rather than merit. Bridgewater's culture was designed to prevent that decay. By making everything transparent and decisions merit-based, the organization could scale while preserving the quality of thinking that made it successful. Critics of Bridgewater's culture argued it was psychologically damaging. Constant feedback and evaluation created anxiety and stress. The emphasis on radical truth and transparency sometimes crossed into harshness. People felt their flaws and failures were exposed rather than supported. Some former employees described the culture as cult-like, with Ray's principles treated as gospel. News articles portrayed Bridgewater as an unusual and sometimes troubled workplace. Ray defended the culture as necessary for excellence but also acknowledged it wasn't for everyone. He believed people should choose whether they wanted to work in such an environment. The tension between performance and culture came to a head in the mid-2010s. Bridgewater faced turnover in senior leadership as Ray tried to transition control. Multiple co-CEOs came and went. Some left on difficult terms, disagreeing with Ray about culture or strategy. The succession process was messier than Ray hoped. Part of the challenge was that Ray's personality was so central to Bridgewater that removing him created a vacuum. Who could embody the principles with the same conviction? Who had the believability to challenge the organization the way Ray did? These questions proved difficult to answer. By 2020, Bridgewater had stabilized under new leadership. The firm continued managing over $150 billion with strong performance. The culture remained intense but perhaps slightly moderated from its most extreme forms. Ray stepped back further, focusing on writing and sharing his principles with broader audiences. He had proven that systematic thinking and radical transparency could build an extraordinary investment firm. Whether it could fully outlive its founder remained to be seen. Ray's influence on the investment industry is undeniable. Systematic approaches are now standard at sophisticated institutional investors. Risk parity principles inform portfolio construction at pension funds and endowments globally. The idea of balancing different economic scenarios rather than predicting which will occur has become conventional wisdom. Machine learning and algorithmic trading, areas Bridgewater pioneered, are now ubiquitous. Ray helped transform investing from art to science, from intuition to system. But Ray's deeper contribution might be his principles for thinking and decision-making. The idea that you should systematically learn from mistakes rather than hide them. That disagreement should be explored rather than suppressed. That track record should matter more than credentials. That believability should determine influence. That radical transparency creates better decisions despite psychological discomfort. These ideas challenge how most organizations operate. While few organizations fully embrace Bridgewater's approach, many have adopted elements. The conversation about organizational culture and decision-making has been shaped by Ray's experiments. Ray's work on economic frameworks also deserves recognition. His template for understanding deleveraging provided clarity during the 2008 crisis when many economists were confused. His framework for thinking about debt cycles helps investors and policymakers anticipate what comes next. His model of the economic machine, explaining how productivity, debt, and credit cycles interact, has educated millions through videos and writings. Ray made complex economic concepts accessible and actionable. You don't need a PhD in economics to understand his frameworks. But understanding them gives you an edge in anticipating economic developments. The geographic scope of Ray's influence is also noteworthy. Bridgewater has always been a global firm, investing across all major markets. Ray's early interest in China and relationships with Chinese officials gave him unique perspective on the world's second-largest economy. His frameworks explicitly account for differences across countries in terms of debt levels, policy tools, and institutional structures. Ray thinks globally in ways that purely domestic investors don't. This global perspective was ahead of its time in the 1980s and 90s but has become essential as capital flows globally and economies are interconnected. Ray's philanthropy and later career focus on education also matter. He has donated hundreds of millions to charitable causes, particularly education and ocean conservation. He created animated videos explaining economic principles that have been viewed by tens of millions. He wrote principles explicitly to share what he learned so others could benefit. He speaks at universities and conferences about decision-making, economics, and life lessons. Ray could have simply enjoyed his wealth in retirement. Instead, he's actively trying to share knowledge and frameworks that took him 50 years to develop. This generosity with intellectual capital exemplifies his principle that sharing knowledge creates more value than hoarding it. The Principles book itself became a cultural phenomenon beyond finance. Published in 2017, it sold millions of copies and was translated into dozens of languages. Business leaders, athletes, students, and people in all fields found value in Ray's frameworks. The idea of writing down your principles and constantly refining them resonated broadly. People applied Ray's decision-making frameworks to their careers, relationships, and personal development. The book transcended finance to influence how people think about learning, growth, and achievement in any domain. Ray also created apps and tools based on his principles. The Principles app allowed people to input decisions and get guidance based on Ray's frameworks. It was an attempt to scale wisdom through technology. Could an algorithm help people make better decisions using principles refined over decades? The experiment was imperfect, but it demonstrated Ray's commitment to making his learning accessible. He wasn't satisfied with writing a book and moving on. He wanted to build tools that could help people apply the principles systematically in their own lives. That's the story of the legend Ray Dalio.